Welcome back. We are jumping straight into this whiteboard-style explainer today, totally designed to build your absolute A-star mastery of capital and revenue receipts for the 2026 IGCSE accounting syllabus. I'm so excited to guide you through this. Let's kick things off with a really quick concept recap. Remember, capital receipts are funds you get from non-trading sources. Think taking out a bank loan or selling off a non-current asset. Revenue receipts, on the flip side, are your standard day-to-day trading income, like your everyday sales revenue. Okay, let's master exactly how to record them.
So, here is our roadmap for today's session. We'll start with core concepts, move right into technical execution, level up with ratios and evaluation, and finish strong with some advanced examiner strategies.
Section 1, Core Concepts and Terminology.
Let's lay down the ground rules right off the bat. For the 2026 syllabus, Cambridge has completely transitioned to modern international terminology. That means you have to use exact terms like irrecoverable debts and owner's equity with absolute 100% accuracy. It's a non-negotiable mandate now. Honestly, using the old, outdated terms is just going to heavily cost you marks, and we definitely don't want that.
Underpinning everything we do is the fundamental accounting equation. Assets equals liabilities plus equity. You absolutely must know how a capital receipt, like say a new bank loan that increases your liabilities, is fundamentally different from a revenue receipt, which is going to boost your equity through trading profit. You have to maintain this duality perfectly for every single transaction across the whole fiscal period.
And yet this perfectly illustrates the prudence concept, right alongside the need for total transparency. The rule is simple: never ignore potential losses and absolutely avoid overstating your profits. So why does this actually matter for our topic? Well, if you incorrectly record a capital receipt as a revenue receipt, you're going to artificially overstate those profits. That directly violates the prudence concept and totally distorts reality for the people who actually rely on these records, like banks, business owners, and tax authorities.
Section 2, Technical Execution.
Okay, this is where your methodological approach really comes into play. In the exam, you're going to frequently see the command word prepare. Let's think about how to actually prepare a ledger account. The procedural flow here is completely logical. It always begins by identifying the correct source business document, then it moves seamlessly to the books of prime entry, feeds right into your T-account ledgers, aims for strict mathematical accuracy in the trial balance, and finally culminates in the final financial statements.
Let's apply this practically. If the exam question asks you to calculate the balance, mastering the T-account structure is your golden ticket. Say you get a $5,000 capital receipt from a brand new bank loan. You debit bank, right, and you credit the loan account. But when you're balancing it out at the end, you must clearly, explicitly distinguish between balance brought down and balance carried down. Doing that secures those vital method marks, even if, heaven forbid, your final arithmetic is slightly off.
Now, if a question asks you to state the correct discount, be super careful. A massive, and I mean massive, area where students stumble mathematically is miscalculating their percentages because they fail to differentiate between trade discounts and cash discounts. You have to apply the correct discount at the exact right time in that procedural flow we just talked about.
Section 3, Interpretation, Ratios, and Evaluation.
We are stepping firmly into Assessment Objective 3 territory now. Calculating a basic ratio, that's a baseline skill, but high-level evaluation? That is exactly what defines an A-star response. Just imagine for a second that your business's current ratio has plummeted from a super healthy 2.5 to 1 all the way down to this genuinely alarming figure, 1.1 to 1.
Okay, I want to make this explainer a bit interactive. I want you to put yourself right there in the exam room. Look at this scenario and attempt to list 3 reasons why this sudden, massive drop in liquidity might have happened. I'll give you about 5 seconds to think. Or hey, just pause the explainer right now and jot them down.
All right, let's see how you did. To effectively analyze that drop, you should be asking yourself a few key questions. Has inventory been wildly overpurchased? Are trade payables being settled way too slowly? Or, and this is highly relevant to our specific module today, are the cash reserves heavily depleted because of a massive capital expenditure? You absolutely need these analytical tools in your belt to effectively evaluate the business and score those top marks on the high-level questions.
You also really need to be on your toes with interfirm comparisons. Comparing two totally different businesses is notoriously tricky because they so often use completely different accounting policies for their capital assets. For example, firm A might use the straight-line method of depreciation for a capital asset, while their main competitor uses the reducing balance method.
Those contrasting capital accounting decisions make direct, surface-level comparisons almost completely impossible. You really have to look deeper. And to truly evaluate the real quality of a profit, you have to look at factors that are completely invisible in the ledgers. We're talking about those crucial non-financial factors. What's the staff morale actually like? How prime is the physical business location? What is their overall reputation out there in the market? These things are absolutely vital when assessing a business's long-term sustainability and their true return on capital employed.
Section 4. Advanced Examiner Strategies.
It's honestly surprising how fundamental these common errors are. This advice is derived straight from the 2024 and 2025 Principal Examiner reports. First tip, it's literally just write legibly. Examiners emphasize over and over that students frequently lose precious, hard-earned marks simply because of poor handwriting in their ledger accounts. You also absolutely must strictly distinguish between revenue and capital items. Recording a capital receipt as a revenue receipt is just a fatal error in this exam. And of course, you've got to manage your time efficiently, basing it strictly on the specific weightage of each part of the question.
As we wrap up today's explainer session, I want to leave you with a slightly provocative question to carry into your study sessions. Are you actually communicating your hard-earned financial intelligence clearly enough for the examiner to reward it? Seriously, all the analytical brilliance in the world literally won't get you an A-star if the examiner can't even read your balance carried down. So keep your workings clean, keep your terminology perfectly modern, and keep practicing those high-level evaluations. Keep up the amazing work, and I will see you in the next explainer.